Hello class, welcome to Chapter 6, Deductions and Losses. The learning objectives are to distinguish between deductions for and from AGI, discuss the criteria for deducting business and investment expenses, examine the restrictions for deducting expenses, list the substantiation requirements for deducting travel and entertainment expenses, explain the timing of deductions under both the cash and the accrual methods of accounting, discuss special disallowance rules for deductions, describe tax planning considerations for deductions and losses, describe compliance and procedural considerations for deductions and losses. For the deductions, the Internal Revenue Code, IRC, states all income is taxable unless specifically excluded. IRC states that no deductions are allowed unless specifically allowed. IRC lays out parameters for deductibility. The taxpayer must meet criteria before an expenditure can be deducted. Types of deductions. You have Section 162, trade or business expenses. Section 212, deductions available by individuals for production of income. And then you have other specific permitted deductions. For and from AGI, you have the for AGI, so the example is the business deductions, moving expenses, IRAs, self-employment health insurance. You're going to find that on the page 1 of the 1040. That's going to be above the line. The AGI is the line. From AGI is going to be your itemized deductions or your standard deductions, whichever is greater. For AGI, Section 62 deductions, you can have trade or business expenses, loss of trade or business property, expenses for rental or royalty property, penalties for CDs, retirement plans, medical savings accounts, student loan interest expense up to $2,500, unreimbursed K through 12 teacher expenses up to $250, half of self-employment taxes, and qualified business income deduction. Where the for AGI expenses are recorded, they're directly on page 1 from the 1040. So that's going to be up on the front. Or you can have the separate schedule totals transferred to page 1 of the Form 1040. Limitations on deductions from AGI. Certain expenditures must exceed a threshold before the excess can be deducted. You have medical expenses and casualty losses. So for the medical expenses, you're going to need to have more expenses than 7.5% of your AGI. So on $100,000, you would need to have medical expenses in excess of $7,500. And then whatever is over that $7,500 is what you'd be able to take. Certain deductions may have other limitations like charitable contributions, where you're going to be capped depending on your AGI. Casualty losses, which has changed now, is only being able to take if it is deemed by the government as a natural disaster. Criteria for deducting businesses and investment expenses. So you have business expense, business or investment activity. You have ordinary expense. You have a necessary expense. It has to be reasonable. It needs to be documented, and it needs to be incurred by the taxpayer. So that's why I always say you must have receipts. If you're going to claim something, make sure you have documentation for it. Business or investment activity, profit motive. Expenditures must be because of profit motivated activity. Section 212, individuals can deduct expenses if 1, the activity is engaged for profit, and 2, the trade or business, Tier B, activity must be separate from investment activity. Expenses must be ordinary and necessary to be deductible. Hobby personal expenses are not trade or business expenses. Trade or business versus investment classification. If it's a trade or business, then more flexibility on deducting losses, such as losses on sale of asset, treated as ordinary loss. Trade or business expenses are usually deducted for AGI, where there are much fewer limitations. Section 179 deduction permits immediate deduction of up to $1,020,000 of newly acquired trade or business assets. Trade or business is defined as holding oneself out to others as engaged in selling of goods or services. Trade or business, if held for an investment, then the limitations apply. Loss on sale of an asset, treated as a capital loss, which is subject to the capital loss limitations, may be subject to hobby loss rules, which disallow losses, and deductions are from AGI and may be subject to income limitations depending on the thresholds. Legal and accounting fees, if they're incurred in the ordinary course of a trade or business, then deduct for AGI. Include tax preparation fees for Schedule C, E, Part 1, and F. Legal fees for purchased property must be capitalized to its cost basis. Legal fees incurred for personal reasons are not deductible. Settlements, legal fees associated with sexual abuse or harassment suits are not deductible. Okay, so on the tax preparation, that's going to go on your Schedule C, like we talked about. So that's going to be your profit and loss for small companies. The legal fees for purchasing property, that's going to be included in your cost basis. So if you go and buy property and there's legal fees, you're going to include that in with the cost when you go to depreciate. Capitalization versus expense deductions. Certain expenses must be, which are normally would be deductible, may be required to be capitalized under Section 263. Must capitalize the cost if 1, it provides a permanent improvement or betterment that increases the value of any property, or restores the property to its normal usage. Election to capitalize deduction items. Capitalized items are added to the property's basis. Section 266 allows the taxpayer to elect to capitalize items that normally would be deductible. Interest and taxes incurred for personal property until it is placed in service. Property taxes, interest, and carrying charges on unimproved and unproductive real estate. Taxes, interest, and other expenses in the development of real property. Expenses related to exempt income. Section 265. No deductions allowed for expenses associated with exempt income. Prevents the taxpayer from obtaining a double tax benefit, and interest expense on debt used to acquire tax-exempt securities is the most common situation. Expenditures contrary to public policy. No deduction if payment is illegal or penalty or fine from illegal act. Examples: illegal payments to government employees, kickbacks, rebates, and bribes under Medicare and Medicaid, payments of fines and penalties, treble damages under federal antitrust laws. So going back with the penalties and the fines and penalties, so if you have employees that maybe making deliveries and they get a red light ticket and you pay their ticket, or if they have any kind of traffic tickets, that is not an expense to the company. Kickbacks versus rebate. Generally, illegal kickbacks are non-deductible. A rebate is a reduction on the purchase price of an item and is a reduction of income. The rebate must be paid to the purchaser, not a third person, in order to be excluded by the payer. Expenses related to any illegal activities. While bribes, kickbacks, and fines and penalties for illegal acts are not deductible, ordinary and necessary expenses in running the business are deductible. Taxpayers must report income from illegal activity. However, if activity is drug dealing or trafficking, then no expenses are deductible. Lobbying and political contributions. Generally, expenses associated with lobbying or direct contact with legislators in order to influence legislation are not deductible per Section 162E. The exception is influencing local legislators, city or county, on matters of direct interest to the taxpayer's business is deductible. So for the example, is petitioning a city regarding proposed zoning ordinances. Also, total lobbying expenses under $2,000 are deductible. The exception does not extend to state or federal legislators. Other non-deductible expenses: executive compensation greater than $1 million is not deductible. Applies to the CEO, the CFO, and the next 3 highest compensated officers. Business interest expense greater than A, business interest income, plus B, 30% of the adjusted taxable income is not deductible for businesses with gross receipts that are greater than $26 million for the prior 3 years. Business investigation and pre-opening expenses. Section 195 allows a current deduction for startup and expenses in a year business starts. Current deductions equals the lesser of actual amount spent or $5,000 with phase-out amounts over $50,000. Rest must be capitalized and amortized over 180 months, starting in the month the new business begins. Here's a timeline for the investigation and pre-opening expenses. You have your business investigation expenses, decisions made to purchase, pre-opening expenses, then the business opens, and then you're going to have your Section 162 expenses. Business investigation and pre-opening expenses, Part 2. So on this flow chart, you're going to start, are the expenses incurred by a taxpayer already established in a similar business? If it's yes, the expenses are currently deductible. Section 195 does apply. If it's no, does the taxpayer enter the new business? If it's yes, Section 195 allows the taxpayer to elect to current deduct a portion of costs and amortize the remainder over a 180-month period. If it's no, then it's generally not deductible. When expenses are deductible, on the cash method. The general rule, deductible expenditures when paid, exceptions are prepaid expenses and prepaid interest expense. You can't go and prepay your rent or your interest expense and include it for that year. You need to have that go into the year that it actually expenses will be incurred. Generally, prepaid expenses are not deductible when paid. Exception, prepaid rent can be deducted when paid if period covered by prepayment less than 1 year. Prepayment is required by the lease. Generally, taxpayer can only deduct over a period of time to which interest expense relates. If the taxpayer receives discounted note, then only need to recognize interest income when maturity value of the note is paid. Exception, points can be deducted if 4 requirements are met. 1, amount of specified as points in the agreement. Points are percentage of a loan. Points are established business practice in that region. Paid to purchase principal residence when secures loan. Prepaid interest on a cash basis. Points paid by the seller are treated as if purchaser had paid them. Purchaser is entitled to deduct the points. If taxpayer refinances mortgages, points are not immediately deductible, but must be amortized over the term of the loan. Unamortized points can be deducted when taxpayer terminates loan by another financing source or sale of residence. It's usually deducted on Schedule A, Form 1040.